Good afternoon, everybody. Welcome to the Liberty Call. This is Wednesday, October 26th, 2022. Hope everybody's having a fantastical day out there in the interwebs. It is kind of a mixed day in the market. Things started out pretty good, but afternoon things turned sour, especially the Nasdaq. Technology took a beating. But, it is what it is, so I wouldn't get too worked up over it. If it is your first time watching, please slam that subscribe button so you get alerts when we do go live here. It's usually around quarter after 20 after 2 o'clock after the markets do close. So also, please press the thumbs up, likes, and all that good stuff. I would greatly appreciate it. And let's go ahead and jump in and let me close this. Let's go ahead and jump in and take a look and see how the markets did today. The Dow Jones finished flat. It was up 2 points or 0.01%, closed at 31,839. Excuse me, the S&P 500 was down 0.73, closed at 3831. Nasdaq was down 2.04%, closed at 10,970. Small caps were up 0.34%. The VIX, even though the S&P was down, the VIX still retreated a little bit, 3.9%, still pretty high. It's at 2735 at the moment. Let's see here. Canada was up 0.96, Brazil down 1.54, Mexico up 1.43. Over in Europe, Germany was up 1.09, UK up 0.61, France up 0.41, Euro Stocks up 0.55. Netherlands was basically flat at down 0.09, Spain up 0.97, Italy up 0.45, Switzerland up 0.41, and Portugal up 0.73. Over in Russia, both their indexes were down. The MOEX was down 0.47. The RTSI was down 0.22. And in the Asian markets, finally a green day for the most part. Japan was up 0.67. Australia up 0.18. New Zealand up 1.19. In China, the Shanghai was up 0.78. The SESC component up 1.68. China A50 down 0.21, the DJ Shanghai up 0.94, the Hang Seng up 1%, and the Taiwan weighted up 0.5%. So looks like they got a little bit of relief from the 2-day tumble that they had the last couple of days. So we'll see if that is a longer term trend or if things go back south in the next day. So. All right, well, let's go ahead and take a peek at today's market recap. S&P, Nasdaq pull lower as tech earnings misses fuel slowdown fears. Wall Street wavered on Wednesday, poised to snap a 3-day rally as dour earnings guidance added to mounting fears of a global economic slowdown. Both those fears, along with smaller than expected interest rate hike from Bank of Canada, continued to feed hopes that the Fed might consider easing the size of its rate hikes after its November 1-2 policy meeting. Well, again, I was listening to Peter Schiff earlier today. If you don't know who he is, he's big into gold and stuff like that, but really smart when it comes to the economy and digesting the material. And he thinks the Fed has already taken and going to pivot, not necessarily meaning that they're going to start lowering interest rates or printing money, but in his mind, he seems to think that they're going to just slow down the amount of rate hikes, and instead of doing 0.75%, maybe 0.5% or 1/4%, and that will give some, hopes to the market that things are getting ready to slow down, and we could see a market rally. I don't know. I don't try to second guess what these folks are doing. I kind of look at if they do this or this, what are the consequences of that. Quote, central banks are starting to blink, end quote, said Paul Kim, chief executive officer at Simplify ETFs in New York. Quote, it's part of the larger trend and support the Fed's pivot narrative, end quote. Microsoft and Alphabet shares were down 6% and 8% respectively. Those gloomy reports brought worries over an impending global economic downturn from simmer to boil and spread to other high-profile mega caps, two of which, Apple Inc. and Meta Platforms, are expected to post results after the closing bell. Sales of newly constructed U.S. homes plunged in September while mortgage rates hit their highest level in more than 2 decades, adding to the growing pile of data suggesting a softening economic landscape. Third quarter earnings season has shifted into high gear with 170 of the companies in the S&P 500 having reported. Of those, 75% have delivered consensus beating results, according to Refinitiv. but they have a low bar to clear. Analysts now see aggregate S&P 500 earnings growth at 2.3%, down from 4.5% at the beginning of the month, per Reventive. Among the initial takeaways so far this earnings season, Kim said, quote, two themes are emerging, labor costs and dollar strength, end quote. Dollar strength is a headwind for larger companies with internal revenues, Kim added. Boeing Corporation reported deeper than expected third quarter loss, sending its shares sliding 7.9%. On the plus side, Visa rose 4.7% in the wake of consumer credit companies beating a profit beat. Advancing issues outnumbered declining ones on the New York Stock Exchange by a 2.97 to 1 ratio. On Nasdaq, a 2.2 to 1 ratio favored advancers. The S&P 500 posted 25 new 52-week highs and 2 new lows. The Nasdaq Composite recorded 87 new highs and 54 new lows. So again, it's kind of a mixed bag as far as good and bad. But again, I still think we have a ways to go before things really start to turn around. The market hasn't really capitulated. Haven't seen blood in the streets, as I like to say. And until that time, I would imagine that as long as the Fed stays their course and things do bottom out, then we ride the train back up and go back fully invested in the market, ride that rally, and things should be okay in the long term. But in the moment, things do seem a little dodgy. So, all right. Next up, oil gains as bulls latch onto weak dollar after U.S. stockpile jump. From foe to friend, the dollar's about turn over the past week has helped oil longs find their feet in a market still beset with volatility and less flattering fundamentals. Despite government data showing a jump in crude oil inventories last week, crude prices rose strongly Wednesday for their first breakout since October 19th as players leveraged on a weak dollar and corresponding tumble in treasury yields. Quote, it's a risk-on day across markets and oil is benefiting from that, although crude's fundamentals on their own are questionable, end quote, said John Kilduff, founding partner at New York energy hedge fund Again Capital. New York traded WTI. The benchmark for U.S. crude was up $2.89 or 3.4% at $88.39 a barrel at 1:02 Eastern, after seeing little moves in the three of the past 4 sessions. London traded Brent crude. The global benchmark for oil was up $2.31 or 2.5% at 94.05 a barrel. And why is that? Well, the dollar index. The dollar index, which pits the greenback against the euro, yen, pound, Canadian dollar, Swedish krona, and Swiss franc, fell for a 5th day in a row, sliding below 110 from a high of nearly 115 on September 28th. So that's a big reason why we have seen commodity prices come down, is because the dollar has been peaking. So if the dollar falls back to where it was, like a year and a half ago in the low 90s, we're going to see commodity prices probably go up quite a bit. So gold, silver, oil, all the other commodities that are related to that. And that's because, outside the United States, you'll be able to buy those commodities at a discount versus the dollar. Let's see here. The dollar and yields tanked after data from the Commerce Department showed U.S. new home sales down 11% in September, reversing a large gain from the prior month as spiraling lending rates choked off prospective buyers. The tumble in home sales was an indication that the Federal Reserve could back off from its aggressive rate hike regime that had weighed on risk across the markets. Again, there we have it. These financial journalists are just chomping at the bit to get interest rates back down as low as possible. And I guess if you're in the lending game, it's more advantageous to have more more customers. But in the end, is it worth it long term for our economy, for the dollar, just for everything involved in our, with our money management? I don't know. But right now we're dealing with the consequences of a decade or more of basically free credit. Jumping back in on the oil front itself, U.S. crude inventories rose by 2.588 million barrels last month against expectations for a build of 1.029 million barrels. The Energy Information Administration reported Wednesday. The build in crude stockpiles came despite record high exports of crude for last week, averaging 5.129 million barrels per day versus a relatively small outflow of 3.4 million barrels from U.S. Strategic Petroleum Reserve. Crude stockpiles rose on lower refining activity across most of the United States, with utilization rates at or below 90% on average. except for the East Coast, where demands for fuels kept utilization at virtually 100% as refineries ran at full steam. Gasoline inventories, meanwhile, fell by 1.478 million barrels against expectations for a draw of 0.804 million barrels, serving as an outlier for the EIA data. Gasoline prices rose more than 1% on Wednesday. Distillate stockpiles, however, rose for a second week in a row, rising by 170,000 barrels last week versus expectations for a draw of 1.138 million barrels. In the previous week, inventories of distillates, alternatively known as heating oil and as ultra-low sulfur diesel, rose by 124,000 barrels. U.S. heating oil prices rose 3% on Wednesday after plunging 11% over the past 3 weeks, unusual for this time of year when prices should actually be higher in the run-up to winter. So, again, a weaker dollar has pushed prices up for energy, and we'll see if that is a longer-term trend to continue. All right, next up, some economic data that came out. U.S. goods trade deficit widens on weak exports, new home sales tumble. We already talked a little bit about the home sales. The U.S. trade deficit in goods widened sharply in September, likely as a strong dollar and softening global demand weighed on exports, but that did not change expectations that trade led an anticipated rebound in economic growth in the third quarter. The report from the Commerce Department on Wednesday showed moderate increases in wholesale and retail inventories last month, suggesting slowing domestic demand was forcing businesses to become more cautious about ordering more goods. The Federal Reserve is aggressively hiking interest rates to tame inflation, boosting the dollar and curbing spending. The data was published ahead of the release on Thursday of the government's advanced estimate of third quarter GDP. So we should see how that news is tomorrow. Quote, net exports will continue significantly to GDP growth in the third quarter, adding about 3 percentage points, in quote, said Daniel Silver, an economist at JP Morgan. The goods trade deficit increased 5.7% to $92.2 billion last month. September's increase reversed only a portion of the prior month's declines, leaving the gap considerably smaller in the third quarter. Trade and consumer spending were the economy's only bright spots in the second quarter. According to Reuters' survey of economists, GDP is likely to rebound at a 2.4% annualized rate in the third quarter after shrinking at a 0.6% pace in the second quarter. And remember, yesterday it was either yesterday or Monday, we talked about the article from Brian Westbury at First Trust, and he was estimating prior to this data coming out about a 3% annualized rate for Q3. So it may pull back based upon some of this new data that has come out recently. Exports of goods fell 1.5% to $177.6 billion last month. The decline was led by a 14% tumble in food exports. Shipments in industrial supplies, which include crude oil, fell 3.1%. Exports of consumer goods also declined, but there was also increases in exports of capital goods, motor vehicles, and other goods. The dollar has gained nearly 11% against currencies of the United States' main trade partners this year, which could make American goods less competitive but help the fight against inflation. The Fed raised its benchmark overnight interest rate from zero in March to the current range of 3 to 3.25%, the steepest pace of policy tightening in a generation or more, but not as high as it was in the late 70s, early 80s. I saw a chart where it was a much steeper incline over a very short period of time. Goods imports rose 0.8 to $269.8 billion, which were lifted by 4.4% jump in imports of capital goods, which bodes well for businesses spending on equipment. There were also increases in imports of motor vehicles and consumer goods, likely as businesses stocked up for the holiday season, but imports of food, industrial supplies, and other goods fell. Another report, let's see here. A second report from the Commerce Department Wednesday showed new single-family home sales decreased 10.9% to a seasonally adjusted annual rate of 603,000 units in September. Sales plummeted 17.6% on a year-on-year basis in September. So, the home market is slowing down dramatically. So, and we are seeing some price reductions there, probably mostly due to the fact that interest rates have climbed as much as they have. Jumping back in, the 30-year fixed mortgage rate averaged 6.94% last week, the highest in 20 years, up from 6.92% in the prior week, according to the data from mortgage finance agency Freddie Mac. The median new home price in September was $470,600, a 13.9% jump from a year ago. There are, however, signs that the ebbing demand for homes is cooling house price inflation. There were 462,000 new homes on the market at the end of last month, up from 457,000 units in August. At September sales pace, it would take 9.2 months to clear the supply of houses on the market, up from 8.1 months in August. Quote, the housing market is still normalizing to an economy under pressure from higher borrowing costs, nagging inflation, and uncertainty about the future Fed activity, end quote, said Jeffrey Roach, chief economist at LPL. Quote, housing demand will likely fall further in the coming months, putting downward pressure on median prices, end quote. So I guess if you're buying, that might be a good thing. If you're selling, not so good. All right, one last article here, just some financial planning tips, 5 simple steps for retiring early. And, in my, decade and a half of doing this that's something that a lot of folks have always wanted to do. I want to retire as soon as possible. Well, that may not always be realistic, but let's go through the 5 things here. Number 1, first, you figure out what you need. The first and most crucial step to retiring early, know what you'll need in retirement. The rule many experts stand by is that you have the same standard of living you have now. You'll need about 80% of your current income in retirement. If you're currently pulling in $100,000 in salary, you'll need about $80,000 in retirement income each year. After you've calculated your annual expenses, you can extrapolate to see how much you'll need in total. Be liberal in how long you'll live. I typically use 95 to 100 for most folks. You don't want to plan for your retirement based on you dying at 80, only to reach octogenarianhood and find yourself healthy enough to climb a mountain, but with no money left over to buy hiking boots. That would stink. Lastly, you want to retire at 45 and use 90 as an aspirational life length. That's 45 years of retirement with $80,000 needed each year. Simple math shows you'll need $3.6 million in your retirement coffers. So, and there's a lot of retirement calculators you can find online that'll, you can put a cost of living adjustment in there. I'd range probably about 3%. You could go as low as 2.5 or as high as 3.5. But 3 is a good number that has worked, over my career doing this. So, anyways. All right, make a budget and stick to it. That's a lot of scratch, but it shouldn't be impossible for you to save, provided you're willing to make sacrifices. The best way to make sure you're saving enough for early retirement is to make a budget and then stick to it. Since early retirement planning is the goal, a substantial part of your budget will go towards saving as much more if you are willing to work into your 60s, like most people do. That may mean forgoing vacations, living in a less expensive home, or cutting down on your entertainment budget. Third, figure out your strategy. The next step is to figure out how you're going to go about saving all that money you need. There are several available options, but some make more sense than others. If you have access to a workplace retirement account like a 401k, it's probably best in your best interest to use that, especially if your company has an employer match. Free money is always good. This is a perk some companies will offer where they will match some or all of the money you put into your 401k, which is essentially free money, which is what I said. Make sure you sign up for your 401k plan as soon as possible and put the highest percentage you can. Most plans allow you to use automatic increase, raising your percentage you can contribute each year. Not all workers have access to a 401k though. If this is you, you can use a traditional IRA or a Roth IRA. A traditional IRA uses pre-tax dollars, while a Roth IRA is funded after taxes. With a traditional IRA, you will have to pay tax when you take dispersals in retirement, while dispersals from a Roth are not taxed. If you think your tax bracket is higher now, use a traditional IRA. If you don't, consider a Roth. Another thing, if you have maybe a side business, or you could establish a side business, you could funnel some money through there and just put every bit of it as far as income into, say, like a SEP IRA, or there's a couple of them for small businesses that if you don't have a plan through your job, you could funnel a lot of that money through there. So you're not just limited to to an IRA or a Roth, but you do have to have another form of employment or income to justify the need for that. Next up, don't forget accounts for healthcare. You may feel the need you may feel healthy as a horse right now, but that probably won't last throughout your retirement. You'll need to account for how much you'll need to pay in healthcare costs, both now and in the future. Once you turn 65, you'll be eligible for Medicare. For some people, that's all they need to know. If you're trying to retire early, though, you could have decades to account before you're eligible. Knowing how you'll get insurance and how much it'll cost is key to making a plan to retire early. Also, don't forget about the possibility of needing long-term care later in life. One way to plan for this is to purchase long-term care insurance now. Lastly is remember Social Security. The good news is you won't need to create all of your retirement income, assuming Social Security doesn't fall apart. Some of it will come in the form of Social Security once you reach a certain age. Retiring early will probably mean you don't get that much in Social Security income, but when you're planning for retirement, every penny counts. And if you do have a substantial amount saved into Social Security, and say you have 25, 30 years work life before you do retire. Say you start working at 20 and then you retire at, say 50 or 55. You have to bridge until you do get to Social Security, which is as early as 62, or you could postpone it as late as 70. So I typically try to recommend for folks under normal circumstances, postponing it to the latest possible date. And you have to kind of bridge to that point as far as taking a little more money early from retirement accounts, and then you cut it back once the Social Security kicks in. And hopefully, again, if you plan accordingly and the world doesn't fall apart, you should be able to accomplish those goals. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And hope everyone has a fantastic evening. Good night. Bye.